Analyst expectations. Geo net subscriber addition was muted, but that was known because we get the monthly numbers. Jal Irani, the Senior Vice President for Institutional Equities Research at Edelweiss, joins in. Good morning, Jal. Thank you very much. Well, how do you look at this? At a top line, it's, at the bottom line, it's beaten estimates. There is other income and other earnings. But on individual, verticals, you can complain. So how will the stock react?
So, firstly, we need to understand that, things out there haven't fully recovered. So, across the board, it's been a difficult quarter. And I think within that context, these are reasonable results. Now, within that, as you correctly mentioned, there is a variation. The oil to chemical business, where unfortunately they have not split it up, they don't split it up anymore into refining and petrochemicals. That overall has slid by 29% year on year, the EBITDA. But within that, we believe that petrochemicals have performed very well. And in fact, going forward, that will do even better. Refining, we think that has taken a huge hit. While we were expecting a GRM of $5.8, we suspect that may have come out even lower because the primary products, petrol and diesel, were barely at $4. Now, retail, I think while they have done well to sort of get 96% of the stores operational, yet only about half of them are fully operational, and that continues to especially so while on a low base effect, quarter on quarter, things like fashion is ramping up. But that's still, people are not entirely going and shopping for fashion and lifestyle as yet. Also, I believe that the Geo Mart, which is a very large opportunity going forward, that nevertheless is a very long and, initially investments are going to be very significant in that. So I think that is where some of the sort of lower than expected numbers may have happened there. And of course, Geo is progressing rather well, but to the extent that the ARPUs have surprised positively, their customer ads have been about half of what we were expecting. Okay. So as you correctly said, it's been a mixed bag. I think generally, in any case, expectations before results go up. And if the results are not great, the stock tends to fall. So I would expect a similar trend, I would imagine, this quarter as well.
Jal, good morning. So just on this point, do you think that Steve will be slightly disappointed with no disclosures on GRM separately? Just the O2C business being reported as one unit?
Well, I'd in fact, ask you that question. You're in touch with the street more than I am, but I would think that the disclosure levels are actually declining. And key parameter of GRM, of course, Reliance has got its significant reasons. They want the market to focus on the integrated business and not just refining. But certainly, gross refining margins as an intermediary of analysis of the whole business is a very significant parameter. And not only that, comparability across years, in fact, decades, suffers very significantly. So that is certainly an area of significant concern, especially if one wonders why suddenly in a quarter like this, which has been weak, why suddenly not reported, at least for this quarter. But having said that, it's not just on the refining side of the business. Also on retail, a turnover breakdown has not been given. At one stage, they used to give even EBITDA breakdown across divisions. In all fairness, it's a competitive market, and some of the competition also don't give that. So I think from their perspective, it may be sensible to do that, but certainly from the investor perspective, lack of granularity isn't a good thing. On the Geo front as well, we suspect that they've added fiber to home customers more than your normal mobile phone, or the pace of fiber to home has increased. Therefore, to that extent, the ARPUs have increased because of fiber to home. Now, if they have emphasized that is fiber to home customers increasing rapidly, similarly, one would expect, one would hope for a higher granularity on fiber to home, which has not been provided as well. So I would say that it's very disappointing that granularity and disclosures are going in the opposite direction.
All right. So, Jal, just to wrap this up, what would all of this mean for the stock? Because the stock has underperformed the market. It's down 15% from its own record highs it hit in September. Do you see more pressure?
So, as you're aware, we had downgraded the stock about 6 months back, and you're right, it's underperformed dramatically. We don't see at the moment, whether it's in the form of these results or any time in the near future, any significant positive triggers to change that momentum. Because, one is the benefit of deleveraging has played out, asset monetization has played out, and while the digital momentum is significant, that is also not only just played out, but they've sold off 1/3 of their stake. So the attributable profit to Reliance Industries itself has gone down very dramatically. So as a play on digital, it is reduced by 1/3 to that extent. So for all these reasons, we believe, and as we've highlighted in our earlier report also, the market ask, I mean, the growth asked by the market, especially for the retail and geo businesses, as much as 30% CAGR over the next 10 years, which is a very tall ask. Basically, the market is assuming that Reliance, it's a done deal. Reliance has succeeded. And as good a company as Reliance is, it'll still take 5 to 10 years actually to really succeed. So therefore, we don't see any near-term triggers. We think, despite the last 6 months underperformance, we think that it's unlikely that this is going to go up dramatically from these levels.
Okay, we will leave it at that. Thanks a lot, Jal, for joining us. And those are the analyst disclosures you can see on your screen. Many more stocks and numbers to discuss. So we'll do one thing. We'll take a quick break. On the other side of the break, some technical advice coming through at the start of the week. Mitesh Thakkar and Rahul Mohinder will be with us.